Understanding Bank Account Closures, a Financial Education Guide. Introduction. Why financial access matters. Banking services form the foundation of modern financial life. Most people rely on bank accounts to receive income, pay bills, save money, and conduct everyday transactions. For businesses, banking relationships enable payroll processing, customer payments, supply chain management, and access to credit facilities. When a banking relationship ends, whether initiated by the customer or the institution, it creates practical challenges that extend beyond simple inconvenience. Understanding how and why banks make decisions about account closures helps individuals and businesses navigate the financial system more effectively. Recent legal filings have brought renewed attention to the processes banks use when closing customer accounts, the explanations they provide, and the options available to customers who believe closures may have been handled inappropriately. This situation provides an opportunity to examine how financial institutions balance regulatory obligations, risk management, and customer service in their everyday operations. This guide explores the institutional frameworks governing these decisions, common concerns raised by affected customers, and practical steps individuals and businesses can take when facing account closure situations. How banks manage customer relationships. The regulatory environment. Financial institutions operate within complex regulatory frameworks, administered by multiple federal and state agencies. These frameworks exist to protect the stability of the banking system, prevent financial crimes, and maintain public confidence in financial institutions. Key regulatory obligations include anti-money laundering, AML requirements. Banks must monitor transactions for patterns that might indicate money laundering, terrorist financing, or other illicit activities. This involves reviewing transaction volumes, geographic patterns, and business activities. Sanctions compliance. Financial institutions must ensure they do not provide services to individuals, entities, or countries subject to economic sanctions. Compliance systems screen customers against government watch lists and monitor transactions for sanctions violations. Know your customer, KYC standards. Banks are required to verify customer identities, understand the nature of customer businesses, and assess potential risks associated with each relationship. This ongoing process involves collecting documentation and updating customer information. Risk management frameworks. Regulators require banks to maintain comprehensive risk management programs that identify, measure, and control various types of risk, including credit risk, operational risk, and reputational risk. Account closure decision-making. Banks make account closure decisions through structured processes that typically involve risk assessment. Banks evaluate whether maintaining specific customer relationships aligns with their risk tolerance and regulatory obligations. This assessment considers factors such as transaction patterns, business activities, litigation exposure, and potential regulatory implications. Compliance review. When risk indicators emerge, compliance teams evaluate whether the relationship creates potential regulatory issues. This might involve reviewing transaction history, business documentation, and external information about the customer. Business judgment. Beyond regulatory considerations, banks make business decisions about which customer relationships align with their strategic priorities, operational capabilities, and institutional values. Documentation. Banks maintain internal records of account closure decisions, though these records are generally not shared with customers in detail due to confidentiality. Considerations and concerns about litigation exposure. Communication practices. When banks decide to close accounts, they typically provide notice ranging from 30 to 60 days, allowing customers time to transition to other banking relationships. The level of detail provided in closure notices varies significantly across institutions and situations. Some banks provide minimal explanation beyond stating the closure is a business decision. Others may indicate general categories of concern without specific details. This variation reflects different institutional approaches to balancing transparency with operational and legal considerations. Common customer concerns. Lack of detailed explanation. One frequently cited concern involves the limited information banks provide about why accounts are being closed. Customers receiving generic closure notices may find it difficult to understand what led to the decision or whether they could address underlying concerns. This information gap can create practical problems. If customers don't understand why one bank closed their accounts, they may face similar issues when attempting to establish relationships with other institutions. Without knowing what raised concerns, customers cannot easily easily modify their activities or provide clarifying information. Difficulty finding alternative banking. When one major bank closes a customer's accounts, other institutions may interpret this as a risk signal, making it more challenging to establish new banking relationships. Some customers report being asked about previous account closures during new account applications, and these previous closures can influence approval decisions. For individuals and businesses with complex financial needs, finding institutions willing to provide specialized services may be particularly challenging after experiencing account closures elsewhere. Perceptions about decision-making factors. Some customers believe account closure decisions reflect factors beyond pure financial risk assessment. These perceptions can arise when closures occur shortly after public events or controversies involving the customer. The customer has not experienced financial difficulties or compliance issues they are aware of. Multiple institutions close accounts within a relatively short time frame. The bank's public statements about its values or priorities appear related to the customer's activities or associations. Whether these perceptions reflect actual decision-making processes varies by situation. Banks generally maintain that closures are based on risk assessment and regulatory compliance, rather than other factors, though customers may interpret circumstances differently. Impact on business operations. For business account closures, operational impacts can be substantial. Businesses may need to redirect payment processing systems on short notice, update information with vendors, customers, and partners, obtain new credit facilities to maintain working capital, navigate interruptions to payroll systems or employee payment methods. These transitions require time, resources, and alternative banking partners willing to take on the relationship, all of which may be challenging to secure within typical notice periods. Practical implications for financial consumers. For individual account holders, when facing potential or actual account closures, individuals should consider maintaining multiple banking relationships. Having accounts at more than one institution provides backup options. If one bank closes accounts unexpectedly, this diversification offers continuity for essential financial services. Documentation. Keep records of account activity, communications with the bank, and any explanations provided about closures. This documentation can be helpful if disputes arise or when establishing new banking relationships. Direct communication. When receiving closure notices, customers can attempt to speak directly with bank representatives to understand the reasons and explore whether any actions might preserve the relationship. While banks may not provide detailed explanations, dialogue sometimes clarifies misunderstandings. Alternative financial services. Credit unions, community banks, and online-only financial institutions may offer alternatives to traditional large banks. These institutions operate under different business models and may have different risk appetites or service approaches. For business account holders, businesses should take additional steps to protect operational continuity. Contingency planning. Develop plans for transitioning banking relationships on short notice, including identification of alternative institutions and documentation requirements for opening new business accounts. Relationship management. Maintain regular communication with banking partners about business activities, especially if the business operates in sectors that face elevated regulatory scrutiny or if business models change significantly. Service diversification. Where practical, distribute financial services across multiple providers, rather than concentrating all banking needs with a single institution. This reduces vulnerability to any single relationship ending. Legal and financial counsel. Businesses with complex banking needs may benefit from professional guidance about managing banking relationships, understanding regulatory requirements, and addressing account closure situations. Understanding your options. Customers who believe account closures were handled inappropriately have several potential avenues. Internal bank processes. Most banks have customer complaint or dispute resolution processes. While these may not reverse closure decisions, they provide formal channels for expressing concerns. Regulatory complaints. Banking regulators accept complaints from customers about bank practices. Regulators review complaints to identify patterns or practices that might warrant examination, though they typically do not intervene in individual account decisions. Legal consultation. Customers may wish to consult attorneys about potential legal remedies. The viability of legal action depends on specific facts, applicable laws, contract terms, and ability to demonstrate damages. Legislative or policy advocacy. Those concerned about banking practices can engage with policy processes through communication with elected representatives, participation in regulatory comment periods, or support for advocacy organizations working on financial access issues. Hashtag institutional and policy considerations. Balancing competing interests. Financial institutions navigate multiple competing priorities, serving broad customer bases while managing risk, complying with complex regulations while maintaining efficient operations, protecting themselves from regulatory penalties while providing accessible services, making individualized decisions while applying consistent standards. How banks balance these priorities affects both their business operations and customer experiences. Different institutions may reach different conclusions about the appropriate balance based on their risk, tolerance, business models, and operational capabilities. Regulatory evolution. Banking regulations evolve over time in response to changing risks, enforcement priorities, and policy objectives. When regulatory expectations shift, banks may adjust their practices accordingly, which can affect existing customer relationships. Regulatory agencies periodically update guidance, modify enforcement priorities, and issue new rules that influence how banks assess and manage customer relationships. These changes occur through formal rulemaking processes, enforcement actions, and informal communications between regulators and regulated institutions. Information asymmetries. A fundamental challenge in account closure situations involves information asymmetry. Banks possess detailed information about their decision-making processes and underlying reasons for closures, while customers typically receive limited explanation. This asymmetry exists for several reasons. Banks seek to protect proprietary risk assessment methodologies. Detailed explanations could expose banks to increased litigation. Regulatory examinations are confidential, and banks may not be able to discuss regulatory concerns about specific customers. Internal deliberations about business decisions are generally not shared externally. Whether current practices achieve appropriate balance between protecting institutional interests and providing customers with meaningful information remains an area of ongoing discussion. The role of competition. Banking market structure influences how account closures affect customers. In markets with many competing financial institutions, customers can more easily find alternative services. In markets with fewer institutions, or where customers need specialized services, finding alternatives may be more difficult. Market concentration has increased in the banking sector over recent decades through consolidation. Whether this affects customers' practical ability to access banking services after experiencing account closures is one consideration. In broader discussions about financial system structure, open questions and areas for further exploration, this topic raises several unresolved questions that continue to be examined through legal processes, regulatory discussions, and policy debates. Transparency standards. What level of explanation should banks provide when closing accounts? Would more detailed explanations help customers understand and address issues, or would they primarily increase litigation costs and risks for institutions? Regulatory clarity. Do current regulations provide adequate guidance about when banks should close accounts? Would clearer standards help both institutions and customers better understand expectations? Or would rigid rules prevent appropriate case-by-case judgment? Access to essential services. As banking becomes increasingly necessary for economic participation, how should policy address situations where individuals or businesses struggle to access financial services? What mechanisms might help ensure people are not inappropriately excluded from the financial system? Oversight mechanisms. What processes should exist for reviewing bank account closure decisions? Should regulatory agencies, courts, or other bodies play roles in ensuring appropriate decision-making? Documentation and evidence. In disputes about account closures, what types of evidence are relevant to understanding whether decisions were made appropriately? How should decision-making processes be documented to enable later review if necessary? Consumer education. What information do customers need to understand their rights and responsibilities in banking relationships? How can financial education help people navigate situations involving potential account closures? These questions affect millions of banking relationships and will likely continue to be explored through various channels, including legal proceedings examining specific cases, Regulatory processes developing or updating banking rules. Legislative consideration of potential new legal frameworks. Academic and policy research examining banking practices. Industry initiatives to develop best practices. Consumer advocacy efforts to protect financial access. Conclusion. Banking relationships form essential infrastructure for modern financial life. Yet these relationships exist within complex regulatory and business frameworks that can lead to account closures for various reasons. Understanding how banks make these decisions, what concerns customers commonly raise, and what practical steps can help navigate these situations provides valuable financial education. The processes governing account closures reflect ongoing balancing of multiple considerations: regulatory compliance, risk management, customer service, operational efficiency, and business judgment. Different stakeholders may reasonably view these trade-offs differently based on their perspectives and priorities. For individuals and businesses, proactive financial planning, including maintaining diversified banking relationships, understanding regulatory environments, and developing contingency plans can help mitigate risks associated with potential account closures. When closures occur, understanding available options and resources helps customers navigate transitions more effectively. As the financial system continues to evolve, discussions about transparency, access, and decision-making in banking relationships will likely continue through legal, regulatory, and policy channels. These discussions will help shape how financial institutions and customers interact in the years ahead.